Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon. We've got another episode of Hedgeye and Friends. This one with a return guest, aka the one, the only Mike Taylor. I just pinged him, so we'll just give it a minute or two for him to come join. I'm sure he will be here any second. But with that, pretty interesting time out there in the market. A lot of little quad 4 action certainly is transpiring. We got just casual things are happening out there. Banks are going kaput. Got the Fed bailing out. Trent Wizzo, invite you up to co-host. How you doing, bud?
Hey. Yes, definitely quad 4 action. The quad 4 team as well.
That's right.
XLP, XLV, right? And rest of the aspects.
Yeah, if you look at the basket today, the quad 4 basket was up 1.12%. Versus everything else. Well, I guess quad 3 was about 85 basis points, so that would have been your closest, but that's mainly because of the gold and the TLT and tips kind of type position. But
right.
And Qs was obviously performed well as well. But yeah, some serious outperformance on the quad 4 basket, which is always a good thing. Well, it's a good thing when you're positioned for it,
right? Yeah, and at some point of time, it would be good to reconcile around some of this intermittent kind of tech kind of performance too over a period of time. So today's day is just one day, and one day is not a trend, right? So we have to take that into account. But at some point of time, it would be good to reconcile this tech bullishness as well, while of course financials just completely fell off the cliff.
Yeah, Trent, and that goes back to, sometimes, goes back to the fact that every quad is different, right? And sometimes you may have things that typically backtest poorly that might slightly, on a relative basis kind of, outperform, right? But this and it doesn't mean that it will in perpetuity or throughout all of quad 4, but certainly signals are, the financials and tech remains bearish trend, right? But it's in terms of, I think you're referring to more about relative outperformance at the moment, and that's certainly kind of what you saw today, right? And I think a big piece of that is certainly, if you're looking at XLK trend, is that it is the makeup of Apple and Microsoft in there, and
Yep.
And so if you're kind of looking for, those are two big behemoths that traditionally would be kind of a quote unquote safe haven in terms of kind of, has performed well over last 10, 15 years. And again, just a place where if you're going to have to rotate capital from a, large cap, big sexy 7 standpoint, that rotation certainly would make sense. I mean, if you look at kind of the sexy 7 and how they did, it was Microsoft, then Amazon and Apple in terms of your top 3, and Microsoft and Apple, Microsoft was a little over 2%. Amazon was almost 1.9%, 1.87%, and Apple's like 1 1/3. So again, that rotation makes a lot of sense in terms of like a quote unquote flight to safety and a risk off environment. And so I think, yeah, but you're spot on in terms of, keeping a keen eye on the tech sector and what that looks like. Because I think it's less about today's move and more about where did things play out by the end of the week type thing.
Yep, agreed.
Yeah. So
we can invite other folks on here while we wait for.
Yeah,
Mike,
so I invited Rich. I see Rich Farr out in the crowd. So I had asked him, I guess over the weekend, I think it was, maybe it might have been late Friday, if you wanted to participate. So Rich, I've invited you up to speak, bud. Would love to kind of hear your thoughts on what's transpiring out there, and obviously anybody else who's intimate in the space. Mike Taylor just texted me that he'd be here in just a minute, so that will be transpiring. So we'll get the big guy, which is really why mainly why people are tuning in today, is to hear kind of Mike Taylor. I just give you a little background. So Mike Taylor's been a good friend of the program, both at Hedgeye and certainly of mine here through either weekly notebook reviews or these Hedgeye and Friends. And so we've been lucky enough to kind of have a playbook and hear Mike's thoughts. And Mike, thanks for joining. We've been lucky enough to be hearing your thoughts throughout both quad tail end of kind of quad 2 environment, and then going into kind of quad 4s. And most recently, I think it was May of 22, we had a call, which was really what I highlighted in terms, or Brian Muni guy was kind enough to kind of write up those notes and kind of lay out the time frame or the different kind of boxes to check in terms of the breakdown that could be happening on the horizon. We're now what, about 9 months in, Mike, and we've got one of the things on the horizon here, which would be sort of earnings recession, and that's certainly a big component in terms of the Hedgeye playbook. Where that's the next sort of shoe to drop in our mind, would be the earnings recession. We've certainly moved kind of past a bit of the inflation. Now I know you're in the camp that food inflation is certainly not done, is not sort of over with, but welcome, Mike. Always a pleasure to have you on, and I appreciate it. We had Mike. It was funny. I was going back, but it was quite amusing that we ended up actually having an impromptu session on February 2nd, which was the day the market peaked, right, in terms of the bear market rally. And that's the night that we had that gentleman pop on and said S&P to 6,000, I believe the number was, which made us all kind of chuckle.
Well, he had
Yeah,
a great basis for that. He felt that way.
Yeah.
But Mike, I mean, how you doing, man? First of all,
good. I apologize. I'm a little tardy today. I'm a little bit off my game. I had a little bit of neck surgery today, so nothing big,
okay,
nothing big.
Wow.
Just a bunch of needles. I mean, of course.
Yeah.
So
I know. But you feeling all right?
Yeah, I'm good.
Well, good.
So
well, thanks.
So this is God. This is so. What has happened here? Look, we know that there's a duration mismatch. For all of you know, by the way, for all the listeners, there's a banking problem, and and there's a duration mismatch between deposits and what they bought, and that's always the case. We just haven't had an inverted yield curve that has lasted for over a year to this kind of degree like this. And as banks get redemptions on their deposits, they can run into a problem because they have to start selling their mostly mortgage-backed securities at a loss. And you have a lot of leverage involved here because it's a bank. And so very small losses as a percent of your book can equal the entire equity of your bank very quickly. And that's what started. But I actually didn't view that as the problem. The problem, and many of the bank people out there, and you've heard me talk about it for the past year, is commercial real estate is the problem. And so many of the banks that I was looking at, I really was thinking that the blowups are going to start in the 2Q as they're reporting the busted commercial real estate investments they made, with clients, because essentially everything that was done over the past 3 years, or a lot of it, is underwater. Where it was so bad that they're just going to give the keys back. And so we haven't even seen that happen yet. And that's coming in the 2Q, representing 1Q, meaning the 1Q results coming in 2Q, and then beyond, because this will probably be a multi-year event. And this is what I thought was going to really wreck the banks, especially small regional ones. And I have a whole list. And I'll tell you, I'm short like 5%. That's it. And I'm so mad at myself because this whole thing happened over 2 days, and I was like, damn it, I was teeing up for a big bank mess next quarter, not now. And I believe it or not, I did not see this coming to this degree and this sort of contagion. So it is true. I don't get them all. Oh, you have Rich Farr on the line. Oh, Rich is a speaker. Very good. Rich Farr is a good friend of mine. If you guys don't know.
Here. I am here. My neck is working very well today.
Yeah.
Neck is-
Excellent. Well, it better because you got to have a swivel head, to survive this.
Hey, Mike, talk about kicking yourself, right? I came to a realization a few days ago. So we've been writing a lot about the blowhole in the side of the Fed's balance sheet. And we've done work on the duration. We've pulled the Fed. Fed's done its own research, talking about over $1 trillion in losses. And we have written about this, and we've been
Now,
writing.
for your listeners, this is the crap that they bought over the past several years.
Yes.
That in the event that they have to sell it and not hold through duration, then they would have to take marks, which they're not doing.
Right.
That's why they're rolling everything off at maturation, so they don't take marks.
Correct. So everything we focused on was the Fed's taking losses. They can't sell the bonds. And because they can't sell the bonds, there's too much cash in the system. Too much cash in the system means inflation lasts longer than people want. It's more persistent, right? And it hit us, I want to say, sometime around the close on Thursday, as we're seeing that the Silicon Bank deal was probably not going to go off. This light bulb went off. Holy shit. The banks are all positioned exactly like the Federal Reserve, and yet they can't hold the shit to maturity.
Right. They don't have that discretion. When people want their money back, that's it.
I've been staring at the most obvious elephant in the room for months and months and months, and it did not hit me until they couldn't get the Silicon Bank deal off. I was like, holy shit. They have the same book on.
So, Rich, this is what I was thinking. It starts with commercial real estate, and you'll see the building permits like implode.
Yeah.
And I think we have a really, really smart real estate guy on this call right now because he just started texting me. I'm not going to say his name, but if he wants to jump on too, raise your hand. And you know who you are. Anyway, so I thought that it would be commercial real estate and then building permits crater, which they've already started to roll. And then right after that, the jobless claims lift. And as soon as the jobless claims lift, people are going to have to start pulling deposits. And then we get the banking disaster on the mark-to-market issue.
Right. And Mike, you were referring to the credit risk of the house, right? Not this ALM or asset liability mismatch side of the house.
So no, I was thinking asset liability mismatch.
Okay.
As people lose their jobs, they start pulling their savings, using it. And then we have deposits drop. Anyway, I didn't know how exactly it was going to work. But what I do know for the past year is that when you have an inverted yield curve and quantitative tightening, the probability of something going wrong, well, it's 100%. I just didn't know exactly where. And the shocking, well, if you will, the shocking thing to a degree is that, and now you know it, and you saw it here, when financials blow up, you buy Tesla. So, because that's like what literally happened. And you're like, okay, well, I've seen this before. And this is before the redemptions come, which is very soon. The vanilla guys, basically the active managers, like, we can't own fins, sell the fins. And so they're cashing up. So what do? They buy everything that's not down. And today they bought pharma, tech, staples. And I don't understand, like, but that's okay. This is what they do. This is what they do until people say, I want my money back. And we're probably getting closer and closer to that. I need my money back. We're in the I need my money back for wealthy people right now. And that is because the wealthy people people with $5 million plus accounts. So this is like high net worth clients at Goldman Sachs. And I think 5 million is the minimum. They recently dropped it from 10 million. And they are invested in frequently real estate projects. And so many of these are underwater,
Well,
especially if you were not a savvy real estate person. Meaning where you're buying it through a fund into an entity that has shiny paper and a pitch book and all that stuff. Those are the kind of things that we're doing 3 years ago, 2 years ago, projects with a cap rate of like 5.
Well, Mike,
And now when they have to refinance it for long-term paper after they built the project or they improved the project, get the clients in, the tenants in, and then they refi it. Right now that refi is 9 and the whole thing doesn't work. And so you have to either lose everything and give it back to the bank, or you have to put more capital in to run it at a loss until some date in the future. And that's what I'm seeing. I started seeing it last year with a number of my friends having major anchor investors that got in trouble with real estate, pulling their money out of hedge funds. Calling them up and saying, I need my anchor amount in your hedge fund in 48 hours. Now, they can't get that, but it was a panic attack when these things came about. And it's not just one, it's many. And
hey, Mike, just to expand on that, just for those listening in that may not fully understand what an anchor amount means, could you just elaborate on what that terminology means?
Well, an anchor in a hedge fund is considered a big investor in your hedge fund. Frequently, an anchor investor will be someone who's there from the start.
Right.
And it's frequently 10% of your entire fund, sometimes more.
And that's kind of why I wanted you to expand on that, because it's not just
so it's
not just
really
a small
high
player,
net
and it's
worth
not
guys
somebody who hasn't been with you. So like when they make that phone call, it's like not necessarily last resort, but it means like, okay, they're really evaluating their entire book.
But when they're saying I need it in 48 hours,
yeah,
and you're going to do that, that's a huge ask, because you have to get the whole company to basically eat shit and do it at an executive level. They have the right to hold that till and not return the money until June. So why would you do it now? And so all these guys are needing this cash immediately. And we saw this with collateral, problems with collateral at the in the back half of last year, where the collateral at hedge funds, I had heard of many cases of it being marked at 0. So imagine you have $10 million at a hedge fund. You can borrow against that at many New York banks, some of which in great trouble right now. You could borrow against that hedge fund and post it as collateral and get 30-40% of the equity out of that to use in a real estate project. And in the back half of last year, many of these said, no, now it's worth 0. So you have to come up with more collateral. And that's what we're kind of in full swing on now. And then you say, well, why are we having a collateral problem? And it's really simple. We have an inverted yield curve. That's why. That's why we have a collateral problem. Collateral is worth less.
Mike, you're getting into something that I don't think was fully vetted last week. Why were people pulling their money out of Silicon Bank all of a sudden? And you can make the argument, well, they can go out and buy, 6-month treasuries, 2-year treasuries, get a much better yield. All right, that makes sense, except they could have done that for 2 years straight. For 2 years straight.
Yeah.
So why all of a sudden?
Rich, last time you were on here with me, at least, it was, I believe the fall, and we were, we were having a similar conversation about how attractive the yields were, right? And and yet they could still go higher, but they were still a very attractive, place to park capital.
Why all of a sudden did everyone need to take their money out? And I know, all the backstories, the Sequoia and, Peter Thiel, whatever. But what? There something else is going on. And so, you got into
Rich, let me just hey, I agree with all you guys, but the thing I'm watching, which I think confirms what you're saying, Richard, is, and I'm not an expert in these areas, but if you watch, euro dollar futures and you look at credit default swaps, they're exploding.
And then Mike's mentioned a couple times all the inversions. The world is hedging for a freaking catastrophe. And I'm not smart enough to know where in the hell it's going to happen. But I mean, just look at those things. And hell, SVB probably had the collateral. They had the mismatch, obviously. Why aren't the big banks who are loaded up with cash, like the JP Morgans and whatnot, why aren't they loaning money? I think there's a big global interbank workings that, with all this hedging going on, is out there. And I'm not smart enough to know what it is, but I can tell you what, it's
Well,
not that far
Well,
off.
all right. So hang on now,
I
Arthur.
actually think it's the
Before you
demand.
jump in, let Richard finish
Oh
his
yeah, I'm
thought.
sorry, Richard.
So
Go ahead.
back to you, Richard.
It's Arthur. I think Arthur was saying something there. Okay.
Richard, I think you were finishing a point. You asked a
Yeah, no,
question,
I guess.
and then I think you were building up to a point
Thank
before
you.
Arthur jumped in.
Sorry.
I've already forgotten what I was going to say. But no, I think the point is, and I think Arthur was getting to that, is, all of a sudden out in Palo Alto, people needed money. And you can't tell me it was just yield differential, because they had that opportunity for 2 years almost. Something else changed. And there's things going on that we don't, like Arthur's saying, we don't have the information. Mike, you have talked a lot about that Blackstone REIT and how they walled off. There's private equity and VC issues of things, non-correlated things that haven't been priced in a very long time. And the only way you find out the price is if you go to sell. So I think there's a lot of money frozen in a lot of places. And then all of a sudden, oh, wait, we're hearing the Silicon Bank has little issues, and they take it from there. And I could tell you just an anecdote, on the consumer. So I got a buddy who's pretty high up in a regional mortgage broker, private regional mortgage broker. And I like to talk to him every now and then about what he's seeing. He called this whole thing. He called the whole thing. He said, listen, Rich, there's markets that are going to be down 25, 30, 35% because of what's happening in interest rates. You're going to see 7.5% more. This guy called the whole friggin' thing. So I said to him recently, what's the latest? He goes, I'm going to tell you the latest. People are refinancing their homes at 7.5% where they were otherwise 4 or 5%. They are refinancing at a higher rate. I said, what kind of stupidity is that? And he goes, well, they have 21% credit cards. And I was like, oh. So all this phantom equity that everyone thinks is out there's so much household net worth that's sitting in homes and all that stuff that the Fed gave. The Fed could take away as fast as it gave it. And you're starting to see that now. And given that some of these homes haven't priced yet, people are able to get the equity out. So I don't know. I feel like there is a cash call out there, and you got the Credit Suisse stuff going on. Like, Arthur.
Yeah, Rich, that's a good call out in terms of, I mean, the housing price lag, right, Rich, in terms, I think is what you're getting, because we've seen, from an inflationary standpoint, we've seen commodities obviously have moved lower, generally speaking, right? Like, oil is a huge component of that. It's down significantly off of its sort of summer highs. And you've seen a lot of that piece of the inflation aspect inside of the number kind of move lower. But the last piece, and one that was like the biggest laggard on the way up, is going to be the biggest laggard on the way down too, which, Rich, is what you're referring to, which is housing prices and the fact that inventory isn't necessarily it's pretty sluggish right now, right? Like things are transacting, and you're seeing that happen through the, I think, Mike, you were just talking about the MBS data, right? Like that's going to come out in the next 2 weeks, I think it is, right? And what that
well, I'm really looking at building permits.
Building permits, okay.
Yeah.
Building permits. I think the price component, right, Rich, is a huge piece, right? Because right now it's still relatively artificially
on
elevated.
paper, households look as wealthy as they've ever been. You've got a huge surge in home values, huge surge. But what you can get on paper and what you can get in the market are two totally different things. And it speaks to why all of a sudden you would see, an increase in cash out refi or home refinancings at higher rates because people are looking for the cash.
Or at least to get like access to some of that
Right.
liquidity, right? Because it's the last piece of their portfolio that still has that price action still in it.
Yeah, Mike and I talk a lot, and I know exactly where he's going with the building permits, and he and I have similar contacts. And Mike, I think I shared this with you, but maybe I didn't. Right around the end of the year, I happen to be having dinner next to a contractor, local contractor. And I'm always tuned into stuff like that. He's like a public contractor. I said, how's business going? I said, it's all right. I said, what about backlogs? He said, I still got 2 or 3 months of backlog. I said, okay, that's good. He goes, well, not really. I said, why isn't 2 or 3 months of backlog good? He goes, well, because of the stuff coming down the pike. I said, what's coming down the pike? He goes, larger contractors are underbidding on jobs where they will literally lose cash flow. I said, why would anyone bid a losing price on a job? He goes, because it keeps their workers working. He goes, if you're a larger contractor and you have 5 or 6 jobs going on and you need, Joey to, stay on the payroll because he's got all these other things, you might be willing to take a loss on one project in order to keep everyone moving and everyone doing things. He goes, I cannot do that. I'm a smaller player. I need to make money on a job that I've been on. He goes, so 2 to 3 months from now, when my backlog dries up, I may be firing people, which, by the way, is right now. It would be right now.
As building permits roll.
Right now.
Yeah.
So I want to pivot back to Mike real quick about this subject. Yeah. So Rob, go ahead.
No, I was just going to. So Mike, can you just kind of keep going down that building permits in one of the one or multiple reasons where you're really kind of focusing on that and how that might snowball into other components?
Well, historically, building permits rolling are an incredibly, like a 100% correlation front runner to jobless claims lifting. and that's what I think we're looking at, a very classical inverted yield curve credit problem economic cycle. And the battle that's been going on right now in stocks and why it's been so difficult is because we have full employment. And so full employment, people don't default on anything, even though auto loan defaults are at an all-time high. So we still, overall, the mindset is that they don't default on anything. They keep buying their iPhones and stuff like that. But that bet is completely off when jobless claims lift, and that's fine. But when I look at the over/under here, if you're going to be long, your bet is things are going to get gooder, and that's a word, by the way. So if things are going to get gooder, how the hell are jobless claims going to go lower? Like when you're at full employment and the Fed is trying to kill it, like bet that way, that you have 95% chance things are going to get worse and a 5% chance things are going to get better. Yet the entire market is betting things are going to get better. And so and that's how I looked at it coming into this year, and why I really wanted to sound the bell immediately in January for everyone to take note. We have a huge problem coming, and you really should be long the 2-year. And I'm happy Rich has come onto my side that the 2-year, the argument on being long the 2-year Treasury in size is that within the next year, we are going to be in recessionary conditions. And it will become incredibly obvious that the Fed is going to have to cut. And then that 2-year is going to go from probably, where it got to about 4.9%, and it will go to 1 or less. And that's really my bet. And it was the only thing I could come out with that was probably an incredibly high probability gain over the next year with a very low risk to loss. The only other risk is that the Fed continues to hike rates and the economy doesn't implode throughout the year. And given all the charts, and I'll draw your attention to Gunlock's presentation, Just Markets, it's called, in January. He does it once a year, and he pulls out charts, very similar charts that I look at. And I've been watching him for over 20 years. he's never wrong at nailing a recession. And he was saying, well, okay, about the middle of this year, yep, that's where we'll be. And, these charts are slow moving, and they move over 5-year periods. And just like recessions happen over long periods of time. And we're here. So that was really my bet with the 2-year. And that's really, it's actually my biggest position. My biggest long is the 2-year. Unfortunately, the rest of my book isn't good, but that is.
So, Mike, I know that last time you mentioned that from a standpoint of tactical positioning, right, having a negative beta position or having a net short position kind of helps.
Yeah.
Is this sell-off, especially in the last 4 trading sessions, good enough for taking some chips off the table, or wait and hold on till that actual recession hits in middle of the year?
Well, I look at it. It's a great question. Thank you, Wiz. I've thought of it. Do I want to trade it? And not really. No, I don't. I got bigger near the bottom. I got bigger as soon as this started, and I came in quite sized into January. And I was wrong for about 8%. And that's okay, because I said, well, my downside is I lose 10%. My upside is the way I have it structured, I could make 50 to 150% return, depending on how interest rates go. And so I'm like, that's, whenever you have a 90% chance of a trade working and a 10% downside, if you're wrong, you got to go supersized. Even if you're wrong for a few months, which I was wrong for, I don't know, 2.5, 3 months. So I'd love to thread it, and I'd love to be able to take the chips off, but we haven't even seen all those. We just got the prelude of what's coming, and in my view, and the next thing, once jobless claims start to lift, and I really don't see how they don't, that's it. It doesn't just stop and go away. We get into a real economic down cycle, and these things take, if we're lucky, a year to play out. If this is like 2001, it's 2 years to play out. And honestly, on the other side, remember, if the Fed does engage in quantitative easing again at some point in the next... Oh, by the way, how I have this, I have it on a rolling 2-year. So I'm long the 2-year, but I'm long the 2-year every month. So it's not like I'm letting it mature so that it becomes a 1-year in 1 year. I am just long the 2-year, and it repeats and renews about every month.
Right, and as Gunluck says, that 2-year goes wherever the near-term Fed funds rate go, right?
Yeah, well, the 2-year just started literally in the past 3 days of trading.
Yeah, I mean, it's still at 4%.
Sniffed out, oh, we have a huge problem.
Yeah.
So,
I mean, in the last 3 days, Mike, it cut 100 basis points basically from what they'd been baking in terms of like terminal rate being 5%, right? So now we're down back to 4, which was this is generally the level we were at for the, from September of 2022 to the start of 23. Was generally this level of 4-ish%.
Yeah.
So they're not even. Yeah. Again. So it's kind of right now they're pricing in kind of unchanged for 23. But the question and the reason why you're rolling it for 2 years is mainly because you're expecting, or the probability of them easing increases as recession risk increases.
And I really think it's a probability of them being forced. That's all. And that, look, we're going to be comping a lot of this inflation. So inflation is going to go down materially. And so, quote unquote, mission accomplished. But what's really going to happen that triggers a problem is jobless claims lifting. So, and I just, yeah, I mean, So, and look, we had over the past 3 years a lot of wackadoodle ideas get funded, and that's a lot of jobs that need to be reduced.
The thing,
I mean, think about it. I mean, just look at the auto market. This is a commodity item, automobiles, and they were trading at $10,000 above their quoted price at the dealer.
Yeah, the quoted MSRP, right?
Well,
The maximum
And,
suggested
and
retail
by the
price.
way, they make up that freaking number. So that's not actually
Yep.
what it costs them. It's just the fucking number they put on a piece of paper and say that's the price. And it's going for $10,000 over it. Okay, so it came down. Then it was 8, and now it's like 4 or 5. And an auto loan is, what, 8% if you have good credit. So, and then the argument is that, well, no, they have to buy the cars. It doesn't matter because they haven't been buying enough cars for a couple of years. And my argument back is, well, I understand that argument, but you're not going to buy that car because you can't afford it until you abso-freaking-lutely have to. And it's a disposable. I mean, it's a necessary item, but you can keep a used car running for an awful long time.
Mike.
yeah, but so
Yeah,
sorry,
I was just going to say these things. It's a slow moving freight train that when the economy turns, and yet if you look at
Agree.
street estimates, the top down folks are still earnings growing 11% this year. The bottom up of a couple percent growth. Nobody's out there saying earnings are going to be down 10 to 15% this year. And you have to figure that's the next thing. And I think that's the hardest part about this market right now is typically when we reach this point where banks are blowing up and the Fed's bailing everybody out, stocks are in the toilet. And we're not there. We're not there. You're still 19 times earnings, 18, 19 times earnings. And the earnings number may not be the same earnings number. And, when I think about the stuff you're talking about with job loss, which I really do think is coming, I think about all the passive flows and where all the passive flows have been going. That Vanguard Total Market Index and the spiders and ARC, all these things. And it just seems to me that we already know people needed their money out of Silicon Bank. We already know people can't get their money out of VC and private equity. We already know consumers are hitting their house to refinance credit cards. What's the next thing? It's take your money.
You're asking what's the next source of
Yes.
liquidity, right?
Yes.
You know what it's going to be? It's going to be a tighter belt.
And also money out of the stock market.
That too.
So I still think multiples are coming down and earnings are coming down. I just don't see how, I don't see how you solve for anything other than that.
But Rich, interest rates just went down, so we're going to have a housing boom. There's massive pent-up demand as far as the eye can see. I don't understand where that's coming from, but that's the pitch.
I have a problem with this analogy, and I'll tell you why. There's a Fed study on the number of homes per person, and it's like one of the highest levels we've ever seen, like 2008. And like you say to yourself, how's this possible? I thought there's no housing inventory. Well, you've had kind of a change in the housing industry, in that you have had these Airbnbs and rental. Everybody thinks they're an Airbnb owner now. Everybody thinks that, and I had some experience in this market. And not only does everyone think there's going to be an Airbnb boom, but there's also a lot of shadow banking funding it. And that's the part that you just don't know yet. There's a company down, I think it's in Austin, Vizio or something like that. And I had
Vizio.
That's them. I had a call with them.
Yeah. I used them, by the way. Yeah, for my Airbnb.
So I had a call. Good for you. Good for you. I had a call with them. And
when did you talk to them, by the way?
Ago.
Okay, you should talk to them now. They'd love to have a phone call, but it's the only phone call. I'm not kidding.
So I had to go shopping for a property in Texas. My daughter's going to University of Texas. I wanted to, make her a Texas resident. So I go down there in one of the hottest markets in the country. I talk to the Vizio people. I talk to the lenders down there. And the Vizio one was fascinating because, I was asking, I want to finance a rental property or whatever. And they were like, well, we don't need your W-2s. We don't need your K-1s.
That's right.
We don't need any of this stuff.
That's
I'm like,
right.
well, what the hell do you need? Well, we need your Airbnb revenues. Well, what if I haven't rented it out yet? Well, we're going to project what the Airbnb revenues are going to be. Oh, so you just know. You somehow magically know what I'm going to rent this property out for. So it's all based off of, subjective numbers that have never seen a recession. So that was one thing. Then, I talked to some of the conventional lenders.
Did they tell you have a 5-year lockup on refi, and they'll charge you 5, 4, 3, 2, 1, percent premium?
Didn't even get there. So that's even more interesting.
Okay. Yeah, that's what they're doing. I'll tell you after you talk. I'll tell you the deal that I just did, probably this week.
So I talked to the conventional lenders down there, and the realtors down there are really pushing you to buy in Austin. You got to buy in Austin. It's the hottest market. It's up X% every year. You got to buy. So I'm like looking at some Austin properties. We put a bid on a place, and I'm like, hey, what's going on with the mortgage? Oh, well, we laid off all our mortgage processors. Oh. Oh. Okay.
Yeah, so that's the hold up, right?
So when we found out that flood zone, I was like, okay, this is a great opportunity to just walk away from this friggin' mess.
Yeah, maybe a little less headache paying out of state tuition, eh, buddy?
Yeah. Ultimately what I did is I got away from Austin. I went out to College Station, found a place with a older lady in there. She's a 4-year renter. I'm like, all right, you're not going to get hosed like you're going to get hosed in Austin here, but I learned a lot real quickly about one of the hottest markets in the country. Even that market was turning into bullshit. And so, I highly doubt that all of a sudden all these people were suddenly, wanting to buy homes in the United States. There were no homes for them. The Fed printed money. It didn't print human beings. Okay, there's only so much population growth, and what I think has happened is there's a significant amount of homes that are actually not being lived in as a primary home now. They're being Airbnb properties in some communities. Austin's one, but there's like Naples, Florida. There's other ones where you'll have like housing developments where 10 to 15% of the units are Airbnb, and you may go, well, that's not that much. Well, if they're the marginal change in price, they're going to set the mark for everybody else. If your neighbors can't rent their Airbnb out, then the value of that price is going to go down, and that's going to hurt your property value. And what's interesting about that, the Super Bowl was just in Phoenix, Arizona, and so was the Phoenix PGA Open at the exact same time. And they interviewed some guy there. He's an Airbnb, guy, and he had like 95 properties. And he said, I've been slashing price on my properties for the Super Bowl weekend, and still 50% of my properties are not rented. 50.
As you tell, I can see it. So, Rich, I just rented an Airbnb for a race I have coming up in 2 weeks, and the Airbnb rental was half the price of a hotel.
Well, there you go.
Yeah,
that hasn't happened in a while. Like the premiums had been on the Airbnb side.
I think I'm renting a house for $100 a night.
Wow. Where does that generally, like what area?
Oh, this is in Shittsville. This is in Sebring, Florida. Sebring, Florida. It's like
Shitsville.
it's really,
For
I
anyone
didn't even
listening.
know these places existed in Florida. I mean, but it's like literally cattle country in the middle of Florida, and you can get alligator any way you want it. They got it fried, they have it grilled, any way you want. It tastes like
And the
chicken.
alligators are thinking the same thing about you.
Yeah, exactly. No,
Get it fried.
it's a rough and tumble country out there, but I'm absolutely going to look at it because I'm on the road a lot, as many of you know, racing, and so I'm going to start doing these Airbnbs because the hotels are pretty reasonable, but if I can find Airbnbs at half the price, done. So
Yeah, so this kind of dovetails a little bit in something, and I want to get back to a topic that we were reviewing probably 20 minutes ago at this point, but more on the liquidity front, right? And this tails into exactly what Rich. I mean, this is good. It was a great topic there on the Airbnb side, right? In terms of housing liquidity and what might transpire when the capital call, like so quote unquote capital calls are really needed, or people are in the market that do own 30, to your point, 93 Airbnbs in the Phoenix area, and he's trying to get that person's trying to get liquidity out of the market. So can you talk both just on a small scale, Mike, or how are you thinking about like liquidity generally, I guess, in terms of the flows both in the global markets as well as on a consumer level?
oh my God.
I know that's a big, broad topic, but
I mean, what bothers, it's always like, remember, we always talk about the shoes that drop and the shoes that have to drop. We have the delinquency in autos very, very high right now. We have the price of cars for some reason very, very high right now. I mean, I understand there's a supply and demand issue. And then we have financing of that very, very high right now. Financing of everything very, very expensive right now. And then we've seen the transaction volumes of homes crater, just completely crater all over the world. But let's just say here. So I think that we're seeing the belt tightening. And I think that you're going to see it next, like immediately in the lower end casual dining, Applebee's, stuff like that. I think casual
Chipotle,
going to get wrecked. My consumer guy told me it's already started to move. So, and this is very immediate. And one thing that I really didn't understand until the past 3 years, because as you know, I really focused in on healthcare
of course,
for most of my time, and I didn't, and we lived in a bubble. You live in a bubble, by the way, Rich. You live in a bubble. Well, maybe not where you live, but because you live in like real country with real people. But I lived in a New York City bubble for 20 plus years, and I had no idea that the vast majority of people simply spend every dime that they have all the time, and when they don't have money, that's when they stop going out to eat.
There's a study,
And
Mike, that even six-figure households are paycheck to paycheck now. And when you start looking at the childcare costs and things like that, it actually makes sense. It makes sense.
I saw that too, Rich. I think I saw that. I thought like last week, maybe 10 days ago. It was within the last 10 days. Yeah, it was staggering, the number, Rich. It was. I think again, I got to go find that tweet, but or like the article, but it was a pretty high number. I want to say like 200, like it was 240,000 household or something like that. It was a pretty high number. Or like both parents making over 100,000, something like that. It was like quite astonishing.
Yeah, and it was like 50% or some of the households were paycheck to paycheck. It was not good.
Yeah.
So you get the razor's edge that everyone's on. Hey guys, I got to jump, but I just was happy to join for a little bit there.
No, thank you.
Rich, I'm coming to your dinner.
Can't
All
wait
right.
to see you, man.
Can't wait. Okay, thank you.
Take care. Bye-bye.
Ladies and gentlemen, Rich Farr.
The one, the only. Hey, Trent, was there any on the liquidity front where, like, you've been doing a lot of work on the bank side of things lately,
Yeah.
and so where if we kind of tie it back to what's obviously huge headlines of the last week in regards to on the banking side of things, what kind of analysis have you done in terms of liquidity, both just like liquidity within the
Oh,
banks?
actually, my sense of asking Mike about liquidity was, remember in January how he
Oh,
described
you're
the
talking about the
phenomenon with the
Treasury.
TGA and the Fed and all of that. Now, given that we are running into a debt ceiling, eventually, I mean, there'll be some resolution, right? Like either it could be on the side that, hey, we're hiking it, or no, we're
Yep.
not hiking it. We get a 10% fall in the S&P, and then we again fix it or whatever. So, thinking of those scenarios, right, as well as the global net liquidity with PBOC, BOJ, as well as the local potential liquidity, how do you think it's positioned? Because that net liquidity positioning has not changed, except for this big kerfuffle which we got from the Silicon Valley Bank and the rest of the run on the banking system. So how do those two things intersect?
Well, resolution of the debt ceiling will happen. It has to happen. And there will be some concessions in there, such as lower spending in something. Don't know what it is. But I mean, you're literally talking about it's going to be like $50 billion of spending cuts so they can pat themselves on the back. Just after Biden got a $3 trillion Build Back Better. So the spending cuts are it's nonsense. It doesn't matter. But when that happens, Yellen is mandated to unwind her extraordinary circumstances. And she'll have to come back to the market for probably 6 or 8 months with an extra $80 to $120 billion of debt to sell. And that doesn't mean that treasuries get killed. All that means is that liquidity gets drawn out of the entire system. And then you put on top of that our normal deficit, which is ongoing now at about $100 billion a month, a little bit more, because I think the tax receipts are going to suck. And then we have the Fed's quantitative tightening, which he's probably not going to change until we're 5% jobless. And then lastly, we have student loans that are very likely to come back on. And this is large. It's $300 for 40 million Americans a month. And that will be at the end of August. And
Right. So real quick in that front, right? So specifically for the Fed, you mentioned Fed will continue to hike the interest rate. Let's say it's 25 bips, right, in the upcoming FOMC.
I honestly don't know. If they hike
Okay.
25 bips, this market's getting tanked. Tanked.
So you think they'll stay paused until
I don't know.
next data point? Okay.
Saying if they hike 25 bips, we're getting tanked. The whisper consensus is no more hikes.
Got it.
Period.
Yeah, I heard that too. So let's say they don't hike, right? And do you think he still comes out every month for 85 billion, QT?
Yes.
Okay. So while that is happening, they also open this discount window for allowing borrowing for all these FRCs and the Xeons of the world um, to do their borrowing against their agency MBS or other treasuries at par, right? So does that constitute to a certain degree proxy QE, which would negate the QT effect?
Not really, because remember, they're only going to come and borrow against it if they need
Right.
to. Right?
Only if there's a deposit liquidity.
Exactly.
Yeah.
So is that going to be no? It doesn't create liquidity. It prevents insolvency.
Right. Okay.
So, but I don't think that's introducing new liquidity into the system.
Got it. And that's a great point, because that amounts to approximately, because currently when I was running the numbers, I found the total for overall, I mean, this is FDIC data, right? They had 620 billion up until 12/31. After that, it got slightly better with the slight easing kind of effect. And then most recently, when I was just aggregating all the unrealized losses, as well as the accumulated OCI, right, or the comprehensive income for the listed banks, it was coming somewhere close to like 500-600 billion. Now, assuming only maybe 30-40% of that actually is required for avoiding any run on the bank by the banks, it comes out to a much smaller number. So I agree, and I understand your uh, assessment about it not being some sort of added liquidity, because it's actually a loan that the bank gets against their holdings, so that they're not carrying it held to maturity. So now, when does, timeline wise, from a Domino's perspective, right, or shoes to drop perspective, when does the credit risk start? Is it 2 quarters from now? Is it 4 quarters from now? Is it summer? When does that start?
I think it starts, and the prelude will be building permits.
Okay, got it.
It's going to be at the. I think the real credit problems. Yes, we've already in commercial real estate. We're there. Like, people don't know it yet, but they will in the next 3 months, probably sooner. But yes, Roxy wants to get out of my office. There you go, sir. Okay. So,
and we have Reed Rob in the listener mode. I don't know if he can join us.
I love Reed. Oh my God, he is a messenger from God.
Indeed. So, speaking of which, have you added any more new potential zeros to your list?
I have an enormous number. A lot of them were on my whiteboard, not all of them, but they aren't really working yet for, let's say, 50% of them. And that has a lot to do with, I believe, hedge funds blowing the hell up.
Right.
So I think that we're going to see really meaningful hedge fund redemptions in 2Q, starting in 2Q. And those notices are going to go in now for 2Q. So when I've kind of put all these things together, with the building permits, the student loans, the reverse actions of the treasuries, continued quantitative tightening, I think that we're going to see a real problem with asset values. And and honestly, it looks like this like every time, where we stay in denial for a long time until jobless claims lift, and then it's real. And then the Fed cuts. Everyone gets very excited because they cut. Stocks lift, and then they immediately go down because then we have real world credit problems, because of jobless. And
that goes on for years, right? The repairing of that credit goes on for years before it comes back up again.
Exactly. And when you look at the debt to GDP right now, it's like laughably off the rails, higher than just parabolic. So the probability of something going wrong is very, 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 very high. The probability of the government having a budget for next year that's a gigantic spend is very low to offset a recession, because they've been kind of called out. I mean, just by the projections right now in Biden's own paper, they're estimating that the coupon costs to the federal government are going to be up about 50% next year. And this is the problem that I was talking about, of annualizing these high interest rates on the short end of the yield curve. I think it's going to go down, but that won't really affect the dollars that this federal government is going to have to hand out in coupons next year. So I kind of put all those things together, and I just say, boy, how do asset values go up? I don't know. I have no idea. No.
Got it. So on that front, Mike, we had Reed Rob up here. Maybe he got some glitch or something and he went away. I know we discussed our favorite REIT, MPW, right? And MPW is now in the 8 handle.
Yeah.
Um, any new REITs or any new stories on that front from the real estate side, other than Blackstone or other than MPW, which comes to your mind? I know Aries was one of them on your whiteboard back.
Yeah, it's still there. It's still
Yep. So, any new ideas that came up to your mind, which, along with this kind of run on the bank, would cause that whole asset liability matching issue? And Rob's back. We can play back and forth between you and
I'm at
Rob.
a point now where I have to really hunker down and evaluate for new ideas. I have a
Got it.
lot of ideas right now, and many of them are, many of them have actually come up in the past 3 months. But what it looks like to me is that any company that is a consumer company with a lot of debt is in real trouble. And that's it. And this includes the cruise lines. It will end up being the airlines in the end. And these are really like usual suspects, because we're going into, I think, a very, very classical recessionary, elevated job loss environment. But what's different is that the debt to GDP is astronomical. And we're going to be, during this downturn, we're going to be engaging in synthetic and real quantitative tightening, which I've never seen before. The Fed's probably not going to be able to react to it until much later in the year when they take down the quantitative tightening. But I don't think that'll happen until jobless claims have really ramped. And as you know, the jobless claims ramping is so backward looking. They don't fire these people until they absolutely have to. And I'll give you an example. I know of a bank, a private bank, and investment bank in New York City. And this can be a proxy for most of them. They basically have no business going on. And a woman that worked there called me, who I used to work with, and asked me, well, we've been really lucky because we literally have nothing to do, but they've been holding off on doing any layoffs. This is before this banking thing, so this is a week ago. And she was asking me, do you think that it's going to get so bad that they're going to be forced to do so? Because they've been vocal about it, that they're holding off and trying to keep everybody on board for a turn. And to me, that only meant that when the layoffs come, it will be much larger than 5 or 10%. They'll literally walk in there and take a hatchet to 30% of the people. And part of the reason why they'll have to, well, I'll tell you why they don't want to. They don't want to because they just paid through the nose for everyone they got as they built up.
Including sign-on bonuses and hikes and
Oh,
everything.
yeah.
And plus the ramp-up time, right? Like some of them,
And they
and
don't
plus some
want,
of their people are leaving. Like some of the existing people are leaving, looking at newcomers.
and they don't want to be, and you know how it is. Management doesn't want to look bad. They don't want to be wrong. But I took a big gamble. I expanded. We paid through the nose. We have a really big staff now, and it's ego. And that they're going to sit there and hope because they don't want to be wrong on a really big bet, not realizing that the longer they wait, the wronger they are. And that's the hardest part of staying logical about that.
Agreed.
I talked to a contractor that I know, one of the largest in Maryland, this weekend, and he told me everything's good. Everything is fine. I think we're having a soft landing. People have jobs, and he's getting work. And I said, well, what is it like versus a year ago or two? And he's like, it's 50% less. But this is the funny thing, though. He says, yeah, but I'm going to make just as much money as I did because our margins are better now because of our input costs have gone down. So he's happy because his EBITDA is still the same, even though his revenue is down almost 50%. And he's been able to downsize his company. He cut his company in half with his contract people. So and he's good about it. He's like, we're fine. And then interest rates will go down and the economy will take off, and that's it. Now, you got to remember, you're talking about a person who is not literate or terribly literate in macro financial. So, he doesn't know that. But he'll be one of the last people to see the real economy fall apart, because most people down there, or there's a ton of government jobs, so people won't lose their money. But he's content having good margins and half the revenue.
Understood.
And that's real to me. That sounded a lot like what I'm hearing here, where I'm going to keep things going for as long as I can, because until I absolutely have to, and then I'm going to really take a hatchet to an incredible number of people. And that's kind of what I see kind of everywhere. And so when that hatchet comes, and I believe it's right now, it's happening. You will feel it. When you start to feel it, you have to realize that whatever the bad jobs number that we have coming, the next one after it will be much worse, and so will the one after that. So as soon as it starts, I think it's going to accelerate meaningfully.
Yep, I call it as the layoff porn, right? And there are anonymous forums such as Team Blind or Blind App, on which tech workers go and talk about their layoffs, and they literally lay out a whole lot of information about their companies or their experiences as they go through these layoffs. In fact, there's another website called thelayoff.com. You don't even need an app for that. It's categorized by companies over there, but Blind is a slightly better form. So that actually brings us up to two interesting aspects, and I do want to acknowledge Reed Rob is here. So Reed Rob, congratulations.
You made it.
Yes.
I made it.
Yeah, we were talking about MPW when you had to step out earlier.
Oh yeah.
And,
Can we talk about one thing about MPW?
Yep.
Yeah, sure.
Because I remember when we were looking at this. This is over a year ago, and God, this smells, right? This is and then the deeper you look, the worse it is. Well, Stuart's building a new hospital. Oh no, they're not. Oh, they took all those loans and used it as operating capital. They can't ever file financial now, because the CFO would never, ever want to put his name to paper on that. That's essentially admitting theft. And of course, the CFO is gone now, and as is most of the management team there. And the Stuart is remember, it's only 19% of revenues for MPW, so it doesn't really count now, right?
Well, it will be. Yeah, it doesn't really count. It's still 30% before they sell Utah.
I know, but I love the chicanery that's going on, and then the deeper we looked, the more we realized that Stuart and MPW are the same management team. They're essentially the same company. It's all, I'm sorry, and in my humble opinion, it is very likely a scam. And they've been shaking down this whole thing in a quote unquote semi-legal fashion for the entire duration. And of unprofitable businesses overpaying their rents to pay out coupons on this REIT and keep using more and more and more and more leverage until it runs out, and then that's it, it's over, and we're in the it's over phase.
Yeah, I think so. I mean, so it really only works the way they've contemplated or like set it up, if they have access to capital, external capital, that is. And right now, and the reason why is it's circular, right? So like if you really like if you think of like what Mike just said, anyone, and Mike, tell me if I'm wrong about this, but anyone who knows anything about hospitals knows that it's a very thin margin business to begin with. And the best hospital owners, like if you think of the HCAs of the world, they actually demand, not just prefer, but demand to own their own real estate, because they understand that like when you lease it, when you put a rent burden underneath that very thin margin, it basically lights a fuse on the whole thing. And so if you think about that, it creates this like adverse selection scenario where like the best hospital operators want to own their own real estate, and not necessarily the worst, but like the ones that are struggling financially go to the sale leaseback market to raise capital, and MPW is effectively that entire market, or at least it was. And so they pushed this as far as they could go with these like kind of, struggling tenants of size that are paying above market unsustainable rents, and they were able to do it. It's just another open capital market story, right? Like if you can go out and sell stock, issue bonds at attractive, yields or attractive cost, you can kind of keep this thing going. But now the capital markets are, for all intents and purposes, closed to them, and Steward and Prospect have to function and stand on their own merit. Well, we just basically saw Steward fail. Prospect fail, excuse me, for all intents and purposes, and our contention is that Steward is kind of right behind it and unable to fund itself. So it's a really ugly.
It's now, by the way.
Yeah.
They factored their Medicare receivables for like over 12% interest to make payroll.
To CareMax. Yep.
To make payroll, and it's like when you do that, I mean, they're so out of Schlitz. What I underestimated is that they're all in, and they've been pillaging this entire business, loading it up with debt and stripping it and paying themselves heftily, and whatever stock they had, sell when you can.
Yep.
And that was it. And it's all been just a sham on the index investors and the guys that are like, okay, I'll be long REITs because I like that yield. Not specifically MPW, just all of them. And so MPW might only represent 1% of the book, so who cares? And these guys figured that out and pillaged this entire thing. And now they're at a point where their yield is, I think their yield's 13% now. I think they can't borrow, and their actual cash flows from their businesses is negative. So, I mean,
kind of over,
including, and then at some point they're going to have to take a mark on all these loans that they have out to these insolvent entities, and then it's really, really, really over.
Yeah.
So it's what I didn't realize, like Steward, how far they'd go, bribing officials in Malta to get another shakedown entity. So they really looked long, far, and wide to find, instances where they could make a scam, and MPW was right there helping to fund it. So they all at some point, there is going to be a subpoena for all of the dialogue, texts, emails, and all that stuff from all these guys. And we will find out that they were one and the same company, and basically just running, in my humble opinion, a scam.
Yeah, it's a very combustible situation right now. If you like, I have to drop in a second, but like just one last point, and we've been kind of talking about this. Jim Chanos, not to drag him into this, but he makes some very good points about REITs, including the data centers.
And the industrials, right? Like storage.
Yeah, sure. Absolutely. So one of the metrics that REITs use is AFFO, or adjusted funds from operations. And what you kind of have to accept and like learn as you go is that there's no standard definition for that. And there's lots of leeway around how and what, how companies, different REITs calculate it and what they include. I would put, and again, this is also my humble opinion, I would put MPW's definition of AFFO, which is used to calculate dividend coverage or estimate dividend coverage, like kind of right at the bottom in terms of quality. I mean, this is not me, this is not my opinion. They changed of AFFO over 3 straight quarters last year, right before their second largest tenant stopped paying rent. And moreover, they don't include this recurring, I call it quote unquote capex burden that a triple net REIT should not have, yet they spend like $40 to $50 million a quarter, if not more. Well, that's a real use of cash, and they do get a return on it. It gets added to the lease base, but it's kind of like a big, massive negative NPV loan. If you put 100 million and you get back in a year, you're 93. So like you have to think about that or include it in your cash flow forecast. And when you do that, they're basically borrowing to fund their dividend payment right now. And again, that's not my opinion. That's fact. They borrowed 300 million on their revolving credit facility in the fourth quarter. Well, their ending cash balance was like 240, meaning if they hadn't done that, they would have had negative cash. So like when I say they're borrowing to fund their dividend, that's not me just like opining. That's actually what's happening.
That is stunning.
Yeah, it's wild. Anyway, I'll let you guys go. I don't want to hog all the time, but thanks, Mike. Thanks for the kind words. Trent, Rob, be well. I actually gotta run and help with the wife with the kids. So I'll see you guys later.
Thank you. Read Rob, ladies and gentlemen.
Be well, guys. Catch you later.
Absolutely, Rob. Thank you.
All right. So switching gears from REITs to the healthcare sector. Now that healthcare sector is coming up, right? We had one huge acquisition by Pfizer, and then we had the smaller caps taking a beating with this whole Silicon Valley stuff. Did you go out doing any bargain hunting, Mike, when the Silicon Valley stuff hit the biotech? Generally
No.
speaking, not your fund, right? No discussion about your fund. Just asking in
Yes.
general.
Well, you can see real time what my fund's done. So, no, not yet. One of the most astonishing things that I see over and over, and you saw it today, where it doesn't matter how bad tech models or pharma models, fins go down, and so they turn around and buy all of these entities up, and it doesn't really matter what the fundamentals are of these companies, and they move with a very high correlation, and that happened for the large part all of last year. I like down here. Oh, that's not true. So I have definitely acted on it. The HMOs have been smashed, and I think that this was just money coming out and going into tech. I think because there really isn't a problem with the HMOs, but they trade like that. Many of them are trading at a discount to pharma, and that's wild because these companies are sustainable, well-run, sort of an oligopoly, versus pharma that have gigantic holes in their revenue lines due to patent expiry. But they're trading at very similar multiples.
So when you say HMO, it's the likes of United Health, Elevance, which was the former Anthem, those companies,
Yes.
right?
Yeah, I'm not specifically UNH, but like Cigna and ELV, like you just mentioned.
Got it.
They've underperformed, and I had to explain it to my guys, because they were like, because these are such incredible bargains, but they're bargains because all of these HMOs, or most of them, have dropped substantially against UNH, and they're all in the same business. And in fact, all of the slightly smaller ones in UNH are trading at a huge discount to UNH. And so how is UNH so different? It's not. But what is different is where it is in the benchmark. And UNH and Johnny John are the biggest names in the healthcare benchmark. And I was explaining to them, when people take off money out of that benchmark and take the weight down to plow into Apple or whatever, they are afraid naturally that they don't want to underperform too badly. And so they won't take it so much unless there's a real fundamental reason. They won't take it out of a UNH. They'll go underweight their HMOs by selling everything else but UNH. And that's what they did. So that way they can still have representation in the benchmark and get the liquidity out to plow into another space. And I think that's what we just saw over the past 6 weeks. Big time.
And this is a very important nugget of wisdom for all of the 700 plus audience right now, and those who would even listen to this later on as a recording from the Hedgeye Nation, that how portfolio managers have to think of their trade-offs of the pieces of inventory that they keep in their portfolio from a standpoint of whether the company is great or not is one aspect, but then they have to also understand or play with the allocation, the momentum, and performance aspect because that ends up driving the overall performance. So, definitely a great nugget of wisdom, Mike.
So,
Well, it's a big
Mike,
reason
sorry,
also
Mike,
why Apple
Mike.
stays up, and that because it's such a big piece of the benchmark, anyone who is going to sell it is taking a very, 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 very big bet against the benchmark. So that's one of the reasons why Apple will hold up so well. In the past, if you recall, the mighty giant General Electric, that thing was a disaster, and it took forever for it to fall apart. But when it did, oh my God, you just had decades and decades of money that had to get out of it. So I'm not saying Apple's going to do that. I'm just saying that's how frequently these large benchmark weightings will trade. And in this case, you're seeing that in UNH versus a Cigna. But right now, that spread is so wide and the valuation is so compelling when you pair that versus a pharma that when I look at that and I'm like, okay, over 5 years, which is going to outperform? Cigna. Absolutely. Will it be over the next 3 months? I don't know. But it certainly will be over the next 18 months versus a pharma. And that really just has to do with sustainable earnings growth. These HMOs have it. Pharma does not. But there's a lot of these pharma names are bigger in the benchmark for healthcare. So therefore, the money, as of the past 2 days, has been plowing into that, blind to what these companies actually do. And we saw that all of last year. So I actually have a lot of alpha positions in the pink fund right now, more than I normally would. And it is actually underperformed pretty badly, 2.6%, but it has underperformed my benchmark. And that's really because I decided to, because I had so many alpha positions / ideas that I decided to actually weight more towards those alpha ideas rather than the benchmark. The top 7 names in that benchmark have absolutely dominated the entire move in healthcare. And that was the case all of last year. A little known fact that many don't know is that it is not legal, if you will, per the rules post 2008, to concentrate your fund, actively managed fund, to be overweight those benchmark names. There are concentration limitations in mutual funds now. Unfortunately, those limitations are not applied to the indices or the benchmarks. So what you're seeing right now is extremely concentrated benchmarks where 5 or 6, 7 names will constitute most of the weighting in the entire space. But none of the mutual funds are able to overweight that or even mirror it. So we're forced to go and find alpha ideas outside of it.
Great point. And I think, Rob, you had a related question, right? Rob, over to you.
I did. We kind of moved on, so we can keep going.
Okay.
Sorry.
No worries, no worries. So related to healthcare, Mike, there's multiple parts of it. You mentioned about HMO, which is your kind of a top pick. What about pharma? PJP and the like.
I'm sorry. You'll have to.
PJ, he's talking about kind of, I think, benchmarks on PJP, so like the Invesco pharmaceutical ETF. I don't actually know what's inside of it, but
Sorry. Hold on. Let me pull it up. What's the ticker on it?
PJP, Peter John Paul, or Peter John Peter, which is totally not aviator language, but forgive me. It's more pharmaceutical oriented versus like the
Yeah.
healthcare. So like XLE, because you were referring
Yeah,
to
and you
more
can see
XLP,
this,
correct?
like for instance, how they did it. It's a pharma ETF, and all the weightings in it, like the max weighting, is like 6%. And so you
Yep.
basically have 6%, 6%, 6%, 5.5, 5.5, 5.5, 5.5, 5.5, 4.
Yeah, so I think they started with 16 names, Mike, and then the performance has just shifted it, so they probably rebalance it every month or something.
Yeah. Yeah. I mean, this is, I don't
It's
know why.
not super liquid, but just in
Uh,
general, your thoughts around the pharma sector within the healthcare. And then next, I'm going to move on to small caps and relatively uh, pre-revenue side of the business. Do you see them getting obliterated with the passive sales, and will they create some sort of opportunity? Because we are in a quad four kind of tape where usually profitless stuff gets just completely annihilated.
yeah, I mean, we're definitely seeing that thing all of a sudden. By the way, we're seeing it where things that are consumer attached with debt are not attractive.
Yeah, Trent. Sorry, Trent. Are you specifically referring more on the healthcare, like on the healthcare, biotech, pharma side, or are you just talking generally in terms of small caps, Trent?
Healthcare, biotech,
Okay.
pharma side, yeah.
Yeah, got it. Okay. Just wanted to make sure we were clear. Okay. So
Yeah. So
so Mike, like going back, I mean, you don't have to go all the way back from when you started, but we'll just use like '08 as an example, right? So in that '08 to or '07 to kind of 2010 time frame, where where did you see
where did
for
you hide?
yeah, where'd you hide? But then also like where did you see opportunity coming out of it, right? So if we kind of spend so Hedgeye sees kind of we've got inflation sort of generally coming to a pause around 4% in Q2, basically from now to the back half of the year. So Q2, Q3, Q4, and then with GDP kind of negative, this quarter or next on a quarter over quarter basis. But so my question is again, we got kind of on paper at the moment, right? In the nowcast model, we got quad one in Q3, and so typically, quad one is a risk on type environment. So again, we take if again, I think if we go beyond kind of the breakdown in terms of what's transpired, like in regards to further downside, if we're going to kind of take a look on the risk on environment in say 6 months, which I know is a lifetime from now, Mike, right? So,
Yes,
but
yes. Many
it's a
careers
lifetime.
from
It's a
now.
lifetime from now, and there's a shit ton of money to be made between now and then, like an absolute shit ton. So I get that, but again, like if we go on two sides of the coin in terms of where would you hide in the near term, inside, or where would you kind of historically hide in the near term, but then
Well,
also
how I hide, I'm
you
personally
invested.
I'm personally
Sorry, go ahead.
my own fund
Yeah.
size, and I'm super long the 2 year.
Yeah, and somebody had a question about that. Do you do it through the futures, or do you do it just through the options
I'm
on the two?
using mostly is Mike Green runs a fund through Simplify. The ticker is TUA.
Okay.
TUA,
Yep.
and that I last time I read the description, its goal is to outperform the 5 to 7 year Treasury,
Perfect. Okay.
and so he has a big latitude on
Yeah.
how to accomplish
Yeah.
that.
Yeah. So the man, yeah, because that's like a managed futures, or not. It's not the managed futures account, but they use futures and other derivatives inside of that in order to make that happen.
Yes, that's
Yeah.
right.
Yeah.
That's
Yeah.
exactly.
So
And
awesome.
it actually like, because right now that coupon is 4 to 5% on the 2 year, depending on the day,
Right.
and so you can do it in a pretty inexpensive way using those coupons to lever up
Yeah. Perfect. So those
synthetically.
awesome. So those listening in, go take a look at UTA.
I'm also not saying that's what he's doing. I'm saying he has the latitude to do that. Because I
Correct.
don't see the book, I don't know how it's exactly set up.
Yeah. What was that ticker again, Mikey?
I'm sorry.
What was
The
that ticker
ticker
again?
is TUA.
TUA. Sorry, I thought it was UAT. Got it. TUA. Yeah. So, on the Simplify website, you can go look at their holdings and kind of take a general assessment as to how they're expressing that exposure to try to beat the 5 to 7 year. So we won't get into nitty gritty
Or
much.
you
I
can
don't think.
Mike Green.
Or, or or we can get my green up, or you can also just go out and again do your own due diligence. But TUA is there, and if you want to express that exposure, you can run alongside Mike there. Rod, now I'm going to come to you in just 1 second. I want to finish this thought with Mike in terms of okay, so if you're let's go on like risk on environment. Let's just like switch gears from like doom. Like I know doom and gloom. I think we've covered that piece. So let's go risk on.
Yes.
Where did you see the most opportunity coming out of like basically a credit crisis environment of the '08 like era of the great financial crisis?
So actually, the better example, because I think it'll be more like it, is '03.
'03, sure, yeah. I would 100%. Yes, I would 100% agree.
And the only reason is because '08 was so fierce and ferocious that and into '09 that you didn't have a lot of time to think about it.
Sure.
Whereas in '03, '02 to '03, I was measuring my companies based upon a multiple of cash on the balance sheet.
Right.
Any company that was trading at 4 times cash was expensive. And I had such difficulty picking one versus the other because they were all a buy. Or not all, but let's say the vast majority of them were a buy, or at least people would think that. In the
Right.
biotech space, it's very difficult for the masses to really estimate the risk and probability of what's in their pipeline. So it tended to be whatever company was the loudest and the most promotional, that was the buy. And that was trading at 3.5 or 3 times cash.
Sure.
So I think that coming out of this, it's going to be a garbage run. And I don't mean garbage run for companies that are going to go bankrupt like AMC, because I have no idea how they avoid insolvency. That's just one of many. But when you go through, there's going to be a lot of good ideas that get thrown out. And how they get thrown out for our listeners is hedge funds, redemptions, which I think are going to accelerate in 2Q and well into the back half of the year. And you're going to have these forced sellers of where they're in really their favorite ideas, and they have to sell a third, and that'll be it. And there's no buyer on the other side. And that's what happened in '02, '01, '02. The difference between then and now is two things. The number of hedge funds and hedge fund money involved is way, 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 way larger. And then number two is the debt to GDP is much, much, much higher than ever.
Way bigger. Yeah.
So the carnage that may happen in SMID cap favorite ideas could end up being very extreme.
Yeah. Right. So where you saw 3.5, 4, I mean, it's possible that you could see half that, and you could see 2.5, whatever you point.
We could still see 3.5, 4 times. But on the other side of that, back in '03, I was looking at 60, 70 companies like that. Now there's 800 in healthcare, right? So that's the difference, is that the number of companies, the sheer magnitude is so much larger this time.
Yeah, that makes sense. And just to clarify on my comment about Quad 1 in Q3, we certainly, so that's the nowcast model on paper at the moment, but that's conditional probabilities, and therefore those conditional probabilities shift and change as new data comes into the fold, right? So as we get, as we get the PPI number, for instance, later CPI tomorrow, PPI, the jobless claims, et cetera, right? Like ISM numbers, all that kind of stuff. So there's about 30 different components for those listening in that go into that nowcast that help tweak that. And so then, so again, on paper at the moment, it's Quad 1, but then we also have a favorite saying of the signal trumps the quad, right, Mike? And so
Yes.
it's all about kind of what the flow in the markets are actually doing. That is really what drives us. So you could see a quad 1 on paper, but a quad 4 type environment where we are in a earnings recession, and therefore, to your point, there is it's not that there's nowhere to hide, but it's a much prolonged process than the quote unquote kind of V-shaped recovery that we saw in 2020. Now, again, there's a lot of caveats in there in regards to what the Fed might do, and if there's QE versus QT, and all those kind of things that over time we're going to kind of, especially as we get closer to Q3, we're going to have a lot more data points in the old cap to assess and evaluate. So, just want to put that out there.
I agree entirely. I wouldn't be surprised if that quad 1 gets pushed back to 1Q next year. So
Yeah.
because that number is really kind of a contingent upon employment staying and consumption staying, like you said, earnings
Yeah.
versus all of that.
So we've got a great slide.
Those are things that are hard to know.
Yeah, we got a great slide that I'll tweet out as well because Keith shared it in the past, and it goes back to that same time frame you were referring to in regards to kind of that 01 to 03 time period. And that was the last time we had like 4 quad 4s on like in a row, and then it shifted to quad 1. But the market didn't really bottom when that quad 1 appeared on paper, because there was still a lot of kind of discovery to kind of that needed to transpire, and people were evaluating, like you just said, in regards to what are the companies that are going to come out of this, and where do I want to actually invest, and do I want to pay 4 times cash, or do I want to pay 3.5, or should I wait till 3, right? Because it'd been 18 months, 24 months at that point, and it was a very prolonged process. So it's possible that we have a similar situation here, where we have, again, multiple quad 4s and then potentially quad 1s on paper, but the market or the signal certainly doesn't mesh with that same quad. But
well,
anyway.
I would say this: in the past, between Saturday and Monday, I have had 3 CEOs reach out to me. 2 are private companies, 1 is public company, looking for work. Meaning let me rephrase that. Looking for a change.
Sure.
Yeah. And so I don't know all the details, because I won't, I'm not going to ask.
Of course.
But that happens, guys. That happens about once a quarter, not 3 times on a Saturday, a Sunday, and a Monday.
Right.
Okay. That's, well, hey, what's going on at Simplified? And I was thinking to myself, if they're calling me, they've already called a lot of people. And so, and I love to assist greatly, because I love helping bright people find their way. It's a gift to me to be able to assist in any way. I mean, that's all we get in the end, and is the joy of assisting. And watching the flowers blossom, and so I am always have my door open, but getting 3 calls in 3 days, and 2 of them were in person at races this weekend, because we get a big motley crew of people who do this from all walks, and I'm one of the few Wall Street people that are in racing, and so it's an interesting mix. I get to see what's going on in the real world a lot, and I had 2 people come out to me and ask me about what they can do next, what they'd like to do, and I didn't even know that they were in trouble. So that sort of tells me that they're seeing a horizon that looks not good, and they want to switch up. And I think that if I'm getting calls like that, that means it's happening everywhere.
Yeah.
So that's kind of like a big tell for me that was very unsettling. But I remember that's what happens, is that everything's fine until it's not, and then people start making decisions, and they tend to all do it at once. And that's kind of what I'm seeing. So I hope we have a soft landing. I mean, I hope that the Fed can thread the needle with an inverted yield curve. He should have done a lot more sooner, and I don't understand why didn't do it last year. But now they're in a huge pickle, and I'll draw your attention to my call with Keith in January, talking about how I hope that they crater this economy, because if they don't, they're going to have to engage in yield curve control, which will cause untold carnage over the intermediate and long term.
Yeah, because
For your listener, that's where the central bank simply prints money to tell you what the yield is, meaning the cost of money, for the government, because they're buying their own debt, and they throw out inflation metrics and everything else out the window. They don't care, because they're literally doing that to save themselves. Japan has engaged in this now for a decade, and they're now at the end where they own most of their bond market. They're a major holder of their stock market. They've told all the pensions and insurance companies how to invest and what to do, and mandated them to buy more, JGBs. And now they have inflation, and they just discovered that they can't stop printing without causing a calamity, an economic calamity. And so they're changing their tune and their story every 3 weeks as to what they're doing, what they're going to do. But one thing remains, is that they cannot stop printing, even though they have inflation.
Yeah, then you see their 10-year go down 11 basis points, aka 27% in the day. So
yes.
So Mike, that actually brings up the international allocations point, right? Do you have any substantial international allocations in general?
Actually, I do. I am long countries that are stealing work from China. Southeast Asia, Mexico, the rents, that's a MBA term, the rents are being excised out of China because their cost of labor is too high. And of course, I mean, something I've been saying for most of the past 20 years is that in the end, you're never going to get your money out of China. You can't. And that's what we're discovering right now, because they're literally out of dollars. So China won't let any money out. And so you're finding out that it's actually a terrible place to do business. And so the outcome is that the other countries are going to benefit meaningfully. In the case of Mexico, I actually think that their sort of labor demand there is such that the folks that would come here to work illegally or legally don't have a tremendous incentive to do so right now out of Mexico. And so they're probably going to see some meaningful economic growth. And it's really just stealing it from China. And part of it is our policy. The other part of it is China's labor issue. They ran out of cheap labor, and they're not making any new workers. Negative population growth and no family, or very tiny family generation. I mean, 30 years from now, China will have 1/3 less the population than they do now.
Yeah.
Who is going to move into those 100-something million vacant apartments that are in China when the population is dropping by 1/3? It's insane. Japan is actually quite similar. Korea is very similar. And all of Southern Europe is very similar. 30 years from now, all of them will have about 30% fewer people living there.
Should be good for climate change, right?
Honestly, I'm trying to figure out a word how to work this to myself.
Was a little glib. I apologize. I didn't mean it like that. But
I don't know what happens exactly, but I assume all of them are going to end up printing an awful lot of money to offset a debt collapse, because the debt's still there. the workers and the consumption and the people aren't. So I just think that they're going to have to trounce their currencies, no matter what, all of them, because I just don't see any other way. Meaning that's politically
like viable,
acceptable, right?
Yeah.
See,
Yeah.
printing money is acceptable because asset values go up and you don't lose elected office. So,
yeah.
And the U.S. is, we'll probably end up having more inflows, immigration, thank God, and we will have a slowly, creeping 0.5% population growth during that tenure. So 30 years from now, the least dirty shirt and probably the best currency will be the U.S. And, there'll be maybe Mexico will be a much bigger player, but still it'll be the U.S. And I don't really see the other way.
Oh, sorry, Mikey. I didn't mean to cut you off. I thought you were done. All right, we got a couple folks that have jumped on. So why don't we get to their questions, Mike, and then we'll call it a night, bud. This has been a great discussion. I always appreciate your time. So we'll go with Rod and then Al. Then I'll go over to the virologist. So Rod, welcome, my friend.
Thanks, Robert.
How you doing, man?
Yeah,
of course,
I'm doing
bud.
pretty
You
well.
good?
I was going to agree with Mike's sentiment toward Mexico. I worked at Ryder for 5 years in corporate strategy, and that trend toward nearshoring really has gotten accelerated amidst COVID, and I think it will continue. As he noted, with the exodus out of China, Mexico makes a whole lot of sense. I think it will continue to. I had a question on the healthcare side, building off that combo.
Yeah, we can return there. Let's go. Yeah.
Yeah, there's a big player trading at 52-week lows, trading at right around its lowest EV to EBIT in a decade. It's got consumer exposure, which I hear you don't like, but it does own Aetna. So don't know if you have any thoughts on that one. Is it an opportunity here, or should people steer clear? Is it a trap?
No, it's actually performed very much like the other HMOs that are not UNH because and they've performed very similarly in the benchmark. These companies over the, as Hedgeye would say, over a tail duration will outperform earnings versus other groups. So I'm definitely.
So that's 3 years or less for those that don't know what tail duration means.
Yeah, because remember, they control the cost and they set the price. So, and if you think that there's going to be a Republican administration in 2024, these names are going to rip.
Appreciate it.
And I do. So, but that's a 24 trade. That's like 7 careers from now.
Yeah, but Rod, what you'll know about Rod likes thinking long term. He likes kind of stashing some stuff away, and yes, that makes sense, Rod. That's very on brand. That question was very on brand, my friend. So thanks for jumping up, bud. I appreciate it. Al, how you doing?
Hey, I'm good, Robert, and
Good.
Mike, thanks. Like you, I'm kind of kicking myself for not seeing Silicon Valley for what it was, because we've been ranting about profitless tech all year, and how about lending to the least profitable and the most immature of tech? What could go wrong? But so my question is on private equity, which we haven't talked about, which to me is levered long the Russell. So what could go wrong? I think we're starting to see a bunch of cracks in the big publicly traded GPs, but what I'm seeing kind of anecdotally is I'm getting spam emails from the Apollos and the Brookfields about, it's a great time to invest in private equity as a retail investor, which is really scary. And in my regular business, let's just say that private equity is nowhere near as aggressive a bidder for companies that are for sale. Last thing, and then hopefully you can comment on this, is that back in 2008, when the mortgage market was imploding, the street at first didn't want to win any bids for product that was being dumped into the market. And part of that turned out to be that they didn't want to have to value the assets they already had at the price they were paying for stuff in the marketplace. If private equity is doing a roll up and they're valuing something at 15 times EBITDA, and then they buy an add-on company to their platform at 7x, that's going to cause some ripples on their marks. Is that what finally drives it? Or how do you see that playing out, and how do we play it? Thank you.
Yes, we've been talking about this since last year, well into last year, and that this will be one of the big shoes to drop. And I mean, just think about the incentive to take your mark. And for your listeners, take your mark means I have a private tech company that's worth $100 because I bought it for $100. And unfortunately, if I turned around to sell it right now, it would sell for 40 cents on the dollar or $40. So what I really should do is mark that in my book. But if I mark that in my book, it would end up in your quarterly statement. And if that happened to end up in your quarterly statement, you might want your damn money back. And that's what they're trying to avoid. So what they're going to say is it's never been a better time. But really the best time to invest is when your dad tells you it's never been a worse time. That's when it's time to buy, because that means that your dad has sold. And so we're in that spot right now where I think on a whole lot of privates are going to have to be marked down materially over the remainder of the year. And people are going to see it in their statements, and they're going to freak out, and they're going to want their money back, which will push down marks on top of that. So it's usually a cascade that lasts for about 2 years. And what we're walking into right now, like if SI is going to sell their 800 some odd private investments they have in tech, I wouldn't be surprised if the average price of those sales are 50 to 60 cents on the dollar. And on that, it's going to force an incredible number of investment funds the auditors will now finally force them to take the marks on their book. And you'll see it with a 1 quarter delay. And that'll be that. And then people may say, well, maybe it isn't the best time to invest. So, I mean, again, this is the problem with an inverted yield curve. This is what happens. And it's always the same, where they don't take the mark for as long as they can until they absolutely have to, because they know what's going to happen is that when people see the return then in their statement, they're going to want their money back. And the whole idea is to take their money and keep their money. So this is another shoe that has to drop. It's a big one. It's a big one. And it's kind of like, I actually thought that this would have happened a little sooner, meaning like a quarter. But what I underestimated was the Treasury coming in and creating a synthetic quantitative easing during the debt ceiling debacle. And I really underestimated that. I also underestimated China's liquidity flush of $500 billion in the period of like 4 months coming into the market.
So that begs for reminiscing what Mike did at the last Hedgeye Live in May of 2022. I know a whole bunch of you were there. I definitely met Gavin, Rob, Leslie, a whole bunch, right? What Mike did was, when it was his turn to come up on stage and he was about to be asked on a panel the question about shoes to drop, Mike brought a toilet paper and he was going through one by one factors, which were the shoes to drop. And it was really hilarious. So it was entertaining and educational at the same time. And right after that, I couldn't forget that moment ever, right? So it was brilliant move by Mike. And then eventually we had a whole bunch of aspects, including the credit aspect and consumer aspect. So it was very memorable. So that brings up another point. We have the next one coming up, and Mike, you're coming, right? In the May
Yes, I'm there.
Yes.
I'm doing a panel with Mike Green.
Awesome.
We're going to talk about probably whatever's on the front page of the New York Times, and then we'll make fun of it. So,
Yeah, Rob, you
Yeah,
want to give more information about the upcoming May event of Hedgeye Live,
yeah.
and then
Thanks,
we'll
Trent.
go
Yeah, no,
to.
it's yeah, awesome. And then we'll go over to virologists. So yeah, Hedgeye Live is our premier conference. It's going to be hosted May 4th to the 7th in Stamford, Connecticut. We've got quite the panel, like quite the list of panelists. Everybody from Mike T and Mike Green to Nancy Davis to asset capitalist Hugh Hendry is a keynote speaker. The list is quite. Who else we got? I mean, the list is quite. I'll post the link up to the top in the nest for anybody who's interested. But yeah, it's an amazing event. It's all kind of so that all happens on the Friday. Is a bunch of folks and speakers and what have you, and then on late afternoon and Saturday morning, you get to speak with all of our Hedgeye analysts and sector heads in their respective sectors and stuff like that. So it's a really great educational weekend and really spearheaded by a ton of phenomenal conversations in between those sessions and in the evening, with between whether it be at the dinners or the cocktail hour, and it's all kind of comes to a big build up, right, Mikey, at the bash, the Hedgeye bash on Saturday night, and
yeah.
I can tell you firsthand because I've been in those meetings that not many people are, but it's going to be quite a party. So it should be a lot of fun. I'm excited for you to be there and yeah, it should be a really good time. Great
And
conversation.
where can people find out more about this event, Rob? If
Yeah,
somebody
I'll put it up in the
wanted to
Nest
come.
Trend. You can go to hedgeyelive.com. Is really the easiest way to do it. But I'll put it. I'll go find a link, buddy, and I'll put it up there. But hedgeyelive.com.
So
Awesome.
before the virologist comes on,
Yeah.
I wanted to make a point that we've had not one question on COVID, and I stand by what I was saying last year is that there will be no COVID vaccinations this year. So, and COVID is absolutely over. Meaning the vaccinations for COVID is over. COVID isn't actually over,
No,
but
yeah, it's just
but the
now the flu,
vaccinations
basically.
for it are. I don't believe that they can ever come out with a version of their vaccination that will be in time to meet the prevalent strain. So by the time they come out, the strain will have already moved on, and we're on to another one. So there's no purpose. Like there's just, in my opinion, there is not much purpose in getting vaccinated, and there wasn't as of probably the middle of last year.
Can I jump in now? Thanks, Michael, for that.
Yeah, I was taking a bet behind the scenes of whether or not you were actually a girl,
Yeah,
or a woman. It's just you never know on the internet. You never know, right?
yeah,
So,
yeah.
but really awesome that you
Th-
are.
thanks,
So yeah,
thanks for letting me add.
absolutely. Cheers.
So, Michael, you just two things that you had brought up. You were discussing kind of like these statistical numbers over population deficit in some countries. So that just prefaces a conversation. So have you heard of Ed Dowd? He's runs finance tech, and he brought up all these excess deaths in 2021. And we're looking at excess deaths of almost 25% in the workforce age 25 to 49. And that's based on actuary data from life insurance policies. Those excess deaths.
Yeah, it's stunning. It's
Okay.
stunning. The numbers are stunning. They're absolutely stunning. And I mean, COVID has had a huge impact, but I
These are
don't. I literally.
So these are non-COVID related deaths. So we teased out the data. So this is an area where I'm kind of a little bit of an expert in, and I've never been on social media in 3 years for these reasons. So I've worked only in COVID and rare diseases and forecasting, and so we have like an uptick about 32% right now in autoimmune and rare diseases that we haven't had before. And so,
yes.
okay, so I was just gonna ask you a quick question. Pfizer picked up Seagen today, and Gilead's building out their cancer company essentially. But Moderna has 17 mRNA pediatric vaccines that they're going to be replacing with standard egg-based vaccines, all of which are going to come out at least triple to quadruple the price of our regular, like generic pediatric vaccines as replacements. With Elon Musk announcing that he is going to be helping production of vaccines with CureVac, even though their vaccine really didn't work out, even though he posted that he's had severe vaccine injury from his vaccines and his nephew got myocarditis from his vaccine. I wanted to know what you thought about the space in terms of, and by the way, they are still mandating the COVID vaccines in all universities, and we've been fighting against that. But it's a tough road over there, and in California, a lot of the schools are still mandating it 6 months to 18-year-olds. So that being said, depending on what states you're in and what's happening with certain senators that are now probably going to become the head of the AMA, I wanted to know your thought process on where this goes with these fertility issues. I think Peter Zane said that in 10 years, China is going to have a catastrophic drop because of their fertility rates. We saw there's an investigation now going on in the UK and in other European countries due to excess deaths, but also with these huge fertility changes. And so that's going to affect the markets in ways that you were discussing, and also having a workforce. If we've had this excess deaths in 25 to 49-year-olds, what does that look like in terms of like layoffs and changing the market based on Ed Dowd's like Six Sigma event ideology of what's going to happen? You have all these players in there, the Pfizers, the Gileads, the Modernas. They have a HIV vaccine they're making. They just approved a cystic fibrosis vaccine with mRNA. They're not stopping with this stuff, and they're fast tracking everything. So it's just going to increase these problems were occurring. So yeah, I just wanted kind of to show you.
That is a lot of
I know.
questions in one question, and I
I
approve
was
of
waiting
it.
a while. I was waiting a while to get to you.
The,
feel like that could be like its own space is all of it in and of
Well,
itself.
you could always invite me and we
it
could do
could
it,
be,
Michael. But
Yeah, let's do it.
yes.
I think that'd be
So,
awesome.
what is your first
you
name?
can call me Chaya.
Chaya. Okay, Chaya. I want to tell all of our listeners I've just started following the Closeted Virologist.
Oh my gosh.
And she asks very pertinent questions. I started trying to number some of these, and so you'll have to
Sure.
help me, because I'm sure that I forgot
Okay.
them. China, pregnancy. Okay, good. Okay, so far as Moderna's pipeline of vaccines, there is an incredibly high probability, in my view, that all of these vaccines are going to demonstrate what I call the purple eyeball, in that they are going to run large studies as vaccines require, and they are going to find in the drug arm a purple eyeball. And a purple eyeball is my theme for a rare, unexplained medical problem, like myocarditis or whatever it is. But to me, it's a purple eyeball. And the probability of a purple eyeball in all their studies is astronomically high, because you are setting off the toll-like receptor cascade of nasty and making yourself extremely hypersensitive to single-strand, double-stranded DNA. And because you're injecting that, you're sensitizing yourself as if you have sepsis.
Yes.
That's kind of what you're doing here. And
you're also going to cause, so we've seen a huge increase in ALS and in Parkinson's and quick onset and quick death, which are people are not aware of right now, that there's 8 products right now that are getting approved for ALS just in 2022. And we're going to see a huge surge in ALS and early onset disease. So everything is fast tracked regardless of, they already know this stuff. They already had all this data. We had to FOIA it and get it, through Pfizer, the 75 years worth of data up front. So they're trying to go away from egg-based vaccines, right? You're seeing all these egg farms and hen farms being burned down all over the US. They want to get away from egg-based. So they're going to be grandfathering in these pediatric mRNA vaccines. I don't know. I know you're more optimistic. I've never seen anything like this in the history of 25 years I've worked in medicine and rare diseases and things, and I've never seen an approval process get sped through with the amount of issues that we're seeing, and they're pretty catastrophic. I got to tell you, like they're not even reported.
Well, some of the issues, though, so the probability of having a purple eyeball event in the drug arm is very high. Now, most of the vaccinations that they're going after are not lethal or barely lethal, meaning that they would have to do an enormous study to show hospitalization and mortality benefit, like RSV, for instance. So that's why RSV has been really difficult to get approved at all. Many have tried. The problem is it's not actually a market because people don't die from it. It's a bad cold.
Yep.
So yes, it might be a convenience, but if you have a 1 out of 10,000 purple eyeball within 18 months of taking that vaccine, it's dead. The FDA can never approve it.
So
in my view, they won't. So they're optimistic, they're hopeful, and we'll see the data. Look, they got a lot of money from COVID, and they're going to spend it. They're going to spend it on pushing this platform. But I believe the platform is stymied because, and then that leads into the pregnancy issues, and it's stymied by the mechanism of this platform, and that you are really revving up the immune system, and it can cause bad effects like autoimmune problems. And mostly all of it stems from autoimmune problems, inflammation in places that you don't want.
Yeah. So yeah, pancreas, gallbladder, heart. So I don't know if you've listened to anything from Dr. Fleming, or you heard me ever speak in any of, and we had one conversation with him about these turbo cancers and terminal amyloidosis, these prion disorders, and the rates that those are going to go up. So we have to find solutions like to those phenomenons of prion disorder, which of course, Amgen, didn't do very well, or what's the other company with their dementia drug and Alzheimer drug, all those monoclonals and whatnot. So it seems like the concern here is the pediatric vaccines for like measles, mumps, and rubella. They're full steam ahead on that in an mRNA format, and to get away from the egg-based vaccine format because it's too hard to make it. And then they're looking at obviously polio. We have an outbreak of polio now, so there's a big warning around that. But there seems to be a huge push. They just created the mRNA Nipah vaccine real quick because there was a small outbreak in Nipah. So that's in phase 1, but they seem to be fast tracking this in a different way, and it's moving under like almost, it's going through a DoD actual like processing, if you know what I mean, where right? Yeah. You have Marianne Gruber and the other guy and about 5 other of the top FDA people. Between them, they had like probably 200 years of vaccine approval experience, and they all jumped off because they were being pushed on the original booster, which was how many billions that we paid in taxes to acquire that, and nobody's taking the bivalent, and those adverse event rates are so high, and they didn't stop it. They didn't even stop. I mean, in January, Pfizer had to make a statement about strokes and that whole Project Veritas leak that came out. And I'm hoping that somebody like you comes in and says this publicly and saves the day. But they keep pushing forward.
Well, the data is going to show it. Don't worry. They're going to, for MMR, measles, mumps, rubella. This is a vaccine that like every kid gets when they go to camp, and it's mandated to go into public schools. You're going to have to do a very, very large study, and the probability of many purple eyeballs is extremely high. So I think when they get the full data set, they're going to say, risk versus benefit. If the risk is higher and the benefit is the same, that's it. It doesn't get approved.
Yeah.
So
I'll send you something. I'll send you something on the back channel, so it'll explain to you. They're going to look at it from a manufacturing issue. That's why with Elon coming in and wanting to do what he's doing is micro production of mRNAs, which is basically like you can quickly produce vaccines in a state, reduce the amount of like egg-based and all that factory flow and all that. They're going to find a way to create it where it's going to be more, easy to produce and economical in one way. And so they're going to use that as, I think, the vehicle. That's my biggest concern, but I'm going to pray that you're right.
They have to do big studies.
Yeah.
They have to do big studies. So, and they will, and we'll see what the data looks like. I will be betting on a purple eyeball.
Oh yeah. Yeah.
So,
We know those. That's for sure.
and I've done this many times before over the past 20 years, where I can see a high risk situation that is not well understood. The purple eyeball comes out and it never gets approved.
Right.
So,
right. And what are your thoughts about Pfizer picking up Segan today?
Pfizer is like one of the many pharma companies that has a patent cliff issue.
Yeah.
And this is simply to replace revenue that they will lose. I'm not sure if this will be an NPV positive project for them. Most of the acquisitions by pharma have not been.
Right.
But
I saw numbers of 10 billion for 7 billion.
44.
Yeah.
Or
something like that, where it's negative 30% NPV.
Okay.
Yeah, exactly. Yeah.
And you have to remember that. Think of the people who are doing these deals often. It's biz dev guys inside of the company, and they they're in a difficult situation because they're trying to find diamonds.
Right.
And think of it like this: they have to find diamonds before all the hedge fund guys do.
Got it.
And they're only buying, for the most part, pretty mature companies on these big acquisitions. And, like, for instance, Clay at SGen and the Baker brothers put this whole thing together. Like, I've known them for 20 years. and so I like, it's really hard for these business development people to get it right. And find an NPV positive project that no one else sees and isn't reflected in the stock price.
Right.
It happens sometimes. Like, I think the deal that Amgen just did for Horizon, I think that they're going to probably make an awful lot of money off of that one. And the reason for that is that their drug to treat blindness associated with thyroid disorder is not approved or even recognized that it's a disease in Europe. And they will very likely grease the wheels over there to get it recognized. And that's going to be a $3 billion perpetuity on that alone. And that justifies the price that they paid, more than justifies it. So I think in that case, they'll make money on it.
Are you aware that a 35% increase in Graves' disease, which is the thyroid eye disorder that you mentioned, is one of the side effects of the mRNA vaccine?
I'm not aware that is the case, but you are getting very close to a purple eyeball.
Yeah.
We're gonna move.
Yeah.
We're
it's
gonna
just
pivot
interesting because
I feel like we could. No, but it's awesome. It's awesome. I want to have. I would love to have a spaces with you. So and ideally you and our health policy sector head Emily Evans. I think it would be a fantastic conversation. Maybe we can bring Mike T back and have it focused just on that aspect of things. But Chaya, you bring in data. Spitting out data rather than narratives and all that other nonsense.
I love it.
That is the Hedgeye way. That is the Mike T way. We love that. So thank you. Thank you for jumping in. Thank you so very much. So I really appreciate it. George, we're gonna go to your question, and then we've been at this for like 2 hours and 15 minutes. So kids are back from gymnastics, gonna go have some dinner. So we'll wrap up with the one, the only, the George Syracuse. No pressure, my man.
Can you hear me?
Yeah, we can hear you loud and
All right,
clear.
good. Yeah, Mike, I just want to let you know, those cigars, I got to send them in the mail, but I bought them in October, and, I kind of had Max in mind, the kind of thing that I would steal from my dad when I was his age, so keep that in mind. This is my question. The bank term funding program, obviously we saw everyone today kind of treat it like it's QE. Has anyone that you follow or talk to done a solid analysis yet on what participation will or may be like in the bank term funding program, and if it will or will not be a de facto QE?
I think we covered this a little bit earlier, and that they're only going to use it if they have to use it, because nobody wants to be nipped that you're using it, because it will become public who's using it eventually.
Right. And George, the approximate numbers we landed up with were, there's a hole right now of about 620 billion as of 12/31. It kind of slightly reduced with the rally in some of these securities in Q1 with the easing. So assuming about, 30-40% need or offtake, if any, right? Worst case scenario. So just talking about scenarios, then that would come out to approximately 200 to 40 billion, that too if required. So the sensitivity analysis would say anywhere between 50 to 200 or 250 billion would be the uptake of that credit, because keep in mind it's a loan, it's a credit.
Yeah, I kind of had
And
the
that's why
same.
it's not QE, because you're just swapping duration.
Correct. Yeah. Mike clarified. I asked a question earlier about whether it would be some sort of a proxy QE. He explained how it's not a QE.
Yeah, I came to the same conclusion. I just wanted to check my sanity based on today's price action.
Cool.
Well, if you noticed, Jim Cramer did say buy. So, right? So, little
Inverse Cramer
Jesus has
ETF.
spoken, and therefore it is true. So
That's a strong way to finish.
I feel like we can't end on that, but hey, it is what it is. Mikey T, always a pleasure. Thank you for coming on. The Hedgeye Nation certainly loves speaking with you, engaging with you, and as do I and everybody else. So can't thank you enough, my man. Looking forward to seeing you in about a month, I guess, at this point. No, I guess 2 months. May 4th weekend. It's going to be a lot of fun. So if you enjoyed what you heard tonight, you can go check out hedgeye.com. We got a lot of phenomenal investment research out there, as well as Simplify. Simplify is the ETF Mike T runs Pink, which is their healthcare ETF, but they've got a lot of other phenomenal ETFs that Simplify as well. But Mikey T, appreciate it, sir.
thank you so much. Have a wonderful night, and good luck. I'll be shocked if this works out for asset values well, and and for many, I hope it does, but I just don't understand how it's going to go that way. So
hey, we got our usual programming, which is weekly notebook review on Wednesday. So that's where we kind of review, midweek, kind of what's happening from weekend work to what we should be preparing for next week, next month, next quarter. Sometimes Mike T drops in. Oftentimes he's in listen only mode, even though everybody wants him to come up, right, Mikey?
I know it's actually an issue, because sometimes I really just want to listen. I'm gonna have to start another phantom account so that I can listen, because then they all make me talk, and I'm like, God, it's hard to learn when I'm talking. So
I hear you, man. Well, appreciate it, guys. Thank you all for listening in. Thank you all for your great commentary and questions. We will we'll see you soon. See you Wednesday.